Well, as the partial government shutdown continues, outside of talking about flight engine tests, we also want to talk about your finances. So joining me now to talk about all that, our good friend, the president of Heritage Capital LLC, Paul Schatz, back on the show. Good to see you again, man.
Thanks for having me.
Always a lot of information you blow through. Boy, was that a wild ride for stocks last year.
Listen, we started off, stocks went vertical, and then they collapsed from there. We had a nice rally into September, and then in December, that was one of the most severe selling waves since the Great Depression. We had 10 straight days where stocks opened lower. I'm sorry, they opened lower and they closed lower than where they opened. Yeah. We haven't seen, I mean, it's really amazing.
All right, so what do we take with that information? I mean, you look at how 2018 did, average it with 2017, we still going up, down?
That's a very optimistic, bullish view. Let's average the 2 years together. Key takeaways for the individual. One, as I said last year, every time I was on, volatility is here to stay. As interest rates have gone up over time, volatility typically follows interest rates. So volatility is not only stocks going down, it's these big swings, multi-100-point moves. They're here to stay for at least the first 6 months of 2019. I think the first quarter is going to be a little rough, a little slippery, a little uncomfortable. But I think the last 9 months of this year, if you invest in stocks, you're going to be fairly happy. I think by the end of the year, on balance, stocks could be up anywhere from 10 to 15%.
What about 401ks versus just stocks? Same thing?
So so the 401k, what's amazing is as stocks go down, people take a step back and they go, geez, maybe I shouldn't invest all this money in stocks. No, folks. The idea is when stocks go down, if you're in a 401k, you're buying more shares at lower prices. Do not change that allocation. What you really want to do is, if you have an allocation of half bonds, half stocks, or 3/4, 1/4, whatever the case may be, make sure you're comfortable with that allocation, like we talk about, and then rebalance it. As stocks went down in the fourth quarter, your percentage got out of whack. At least once a year, twice a year, optimally 4 times a year, you should go online to your 401k account and hit the rebalance. So you'll get back to that 3/4 stocks, 1/4 bonds, or 50-50. Don't, because stocks went down, don't suck your thumb and grab your blanket in the corner and say, I'm not investing in stocks again. Things are fine. We're not going into recession yet.
Yeah. A lot of us have to simplify it even more than that. Do you want to balance it so it's more risky or less risky? And when there's a lot of volatility, you're saying don't worry about being a little more risky? Do I have that?
Exactly right. Stocks are on sale. Listen, stocks go up 8% a year over 100 years. None of us have 100-year time horizons. As you're getting within 10 years of retirement, you want to pull back on stocks a little bit. Within 5 years of retirement, you want to make sure that a devastating bear market like we saw, the dot-com bubble bursting and the financial crisis, that won't irreparably harm your retirement. But if you're the average person in your 20s, 30s, 40s, 50s, and the market went down 20%, you should not be pulling back.
Yeah, you got to make that back at some point and staying the course, I'd imagine, right?
You will, so over most 5-year periods, stocks go up almost every 10-year period, and I don't think anyone could find a single 20-year period in history where stocks have gone down.
There you go.
Over time, you're going to have lots of ups and downs, but after a 20% decline is not the time to say, let's pull back. If you're uncomfortable into these rallies, if you're really uncomfortable in stocks, then pull back into rallies.
How's the Connecticut economy doing?
Well, the Connecticut economy has a lot of very, very strong headwinds. As we know, the cost of living here is very high.
Oh, yeah.
Energy costs, we have our tax policy, I would say, is out of control and shows no signs of abating. We used to be this haven around Rhode Island, Mass, and New York. We were the lowest, so we'd get all these border people living in Connecticut, and now the opposite's happening. So they're going back. The richest people in Connecticut down on the Gold Coast, the hedge fund, the private equity, the 100 millionaires and billionaires are all leaving.
Yeah.
They went to Malloy over years and said, it's enough. He called their bluff and said, you're never going to leave. And now you've got guys like Paul Tudor Jones, the single biggest taxpayer in Connecticut, pulled the ripcord and said, I'm out of here. We have a lot of problems in Connecticut. We have a pension crisis unfolding. We know what's going on with Hartford. We have a municipal problem. We need to make Connecticut real open for business. We will need to be a lot more welcoming in the state than we are. but I think it's going to get a lot darker
Right.
before it gets brighter. But the second half of the next decade, things should get better in Connecticut, just not right now.
It's all a question of time. The time period you look at, whether it's stocks or Connecticut economy. Paul, great to have you on the show.
Thanks for having me. I appreciate it.
A pleasure. I know we could go over a lot more stuff, so let's get you back soon.